All right, everyone. Happy Wednesday. I want to welcome you to the BI Energy Exchange, where we talk about our research and the latest developments in the market. So, for today, we're going to start off with our senior oil analyst, Will Hares, to talk about 1Q earnings from the European oil majors. A pretty exciting week. I think we heard a lot of very interesting set of results, very strong operational performance and cash generation. But break it down for us, Will. What's your read on the 1Q and how do you see things evolving over the course of the remainder of 2021?
Yeah, thanks, Rob. So 1Q was really the best quarter that we've seen since the beginning of the pandemic for the oil majors, and this was largely expected and mostly driven by vastly improved commodity pricing in the first quarter. We also highlighted what to expect on capital distributions from the companies. This is a key focus area for management teams, not least because most or all of the European oil majors, except for Total, has cut their dividend last year in response to the crisis, and so we saw BP at 1Q results follow through on their strong suggestion previously announced that they would resume buybacks after hitting their 35 billion net debt target. We also saw Shell bump their dividend very slightly by 4% and also signal that their buybacks are likely on track to be resumed by year end, we believe, after they hit their net debt target of 65 billion. And I think overall a very strong quarter that will help reassure investors that most of these companies are on the right recovery path. The one enduring weakness that we see extending through mid-year and perhaps beyond are the downstream units. We still saw very weak refining margins, overcapacity on low fuels demand, particularly in for those with exposure to European retail markets. This is as a result of these COVID-19 public health restrictions extending through the first quarter and even the second quarter. So we think that effect is likely to persist. But for nearly all the companies except for Eni, the Italian major, upstream performance was very strong, and I think we're also going to see operational performance start to pick up as well, as in investment levels stabilize from last year.
Thank you, Will. Very interesting. I think one component that you didn't talk about yet is just the continued focus on the energy transition as the results were communicated out. So we saw that Repsol spent about 40% of its Capex in 1Q on clean energy projects. And I think you've got a really interesting anecdote when you look at Equinor and what the clean energy business actually meant to their 1Q results. So, can you talk us through some of those interesting dynamics about how energy transition is playing into their current strategy?
Yeah, of course. I mean, Equinor is an interesting example, and while Equinor's upstream performed very well in the quarter, the company actually generated as much adjusted earnings after tax from their renewables unit as they did with their upstream unit. Now, this is an extraordinary one-off event, and is not and should not be expected to be repeated in the coming quarters. And this is because the company has generated these earnings from farming down or selling partial interests in several U.S. and U.K. Wind farms during the quarter for a $1.4 billion gain. And so I think this is a really good example of how Equinor, as a relative early mover in the energy transition, is addressing some of the investor concerns that we're hearing around the lower rate of project returns from renewables as compared to oil projects. And this is a very good way to pad those returns by farming down partial interests at pretty good valuations as well. and also notably the companies that they sold to were their fellow European oil major peers, so BP and Eni. So it really proves uh, the benefit of being an early mover in some of these big projects. And yeah, we're also seeing very very aggressive targets still coming out of some of the European oil majors on renewable power capacity growth. Um, Total has just said that they're at over 3 gigawatts installed of renewable power capacity, and they are planning over 30 gigawatts already under construction or in development by 2025. So this is not some far off target like net zero 2050 that has received a lot of criticism. This is within the next 5 years that Total will 10x their renewable capacity growth.
Well, there are a number of skeptics out there about the energy transition, and there was a survey that got featured in the FT earlier this week that talked about the idea that many asset managers would really just like oil and gas companies to focus on their core business, oil and gas, and not really do any of this green stuff. What do you make out of this? Is this something where you can see the energy transition unfold and see an evolution, make money in both lines of work, or is there any truth to that thinking at this point?
Well, I think there's enormous amount of risk for companies that refuse to acknowledge that the global energy system is changing, and I think that maybe in the short term the strategy can work out, consolidating oil positions, doubling down on the oil bet, but longer term I think that the writing is pretty clear on the wall. And I think all we have to do is start to look at what's happening in new car sales and electric and plug-in percentages. Europe's new car sales are already at 20% of electric battery or plug-ins. And if you look to Norway, which is really the canary in the coal mine for EVs, they're nearly at 2/3 of new car sales are electric. And so this is a trajectory that oil majors should really be uh, aware of and be planning around, because as we know, 60% of oil demand is derived from transportation fuels, and you also have the increasing efficiency of conventional cars improving as well, and and also overall oil demand growth is slowing and has been slowing for years. So I think there's enormous risks for doubling down on oil near term, at the expense of ignoring the pretty clear long term trajectory for where oil demand is going.
Thank you, Will. I think this is a really good segue to bring on our colleague Elchin Mamedov, our senior utilities analyst. Elchin, you've got a note out over the last week looking at the hydrogen economy and looking at potential for green hydrogen supply. And this is one of the areas that many of the oil majors are really thinking about and talking about. But I think they're at the early stages. But when you look at the space in general, Elchin, what do you see happening in the near term? Is hydrogen something that an investor can already be positioning around?
Absolutely. And after numerous false starts, and despite the recent sell-off in hydrogen and broader renewable names, I do believe it's the enduring trend, and it's the beginning of something big, just like electric vehicles were a few years ago. So I do think it's an enduring trend. The key difference between the oil majors that Will talked about and utilities is that utilities primarily invest solely, purely in green hydrogen, whereas a lot of hydrogen produced today is gray. Whereas oil majors have a mixed approach. They're investing in some green hydrogen, but they are making huge bets on blue hydrogen, which is hydrogen where the produced from gas rather than electrolysis of water, and the emissions from that gas are buried using CCUS technology. So yeah, utilities are betting on green hydrogen. I think that's the way to go. You don't want to bet on blue hydrogen, in my view, because it's a transitional technology for hydrogen, I think, and we will have more renewables coming online, and it's going to be a great source of cost declines for the hydrogen, the green hydrogen, and with lower cost, the uptake will improve, I think. So yeah, so that's what my note talks about.
Elgin, I'm very curious to hear you talk about potential declines or relatively favorable economics for hydrogen. And we're also seeing record high CO2 prices. And I think there's a little bit of a feedback loop there. So, is 50 euros a ton carbon price enough to drive some of these clean hydrogen projects into the market? Does the CO2 price need to be higher? And where do you see this shaking out over the medium and long term?
When I speak to the hydrogen pure play companies, so the makers of electrolyzers or fuel cells, they are less worried about the price of CO2. Obviously, the higher the price of CO2, the more favorable the economics of green hydrogen. But they're more worried about the cost of green electricity. So the LCOE of solar and wind, because that is the key input cost for hydrogen. The shipping is also a big component, but the cost of green energy is the key driver for the cost of hydrogen, as people keep talking about $1 per kilogram or 1.5 at some point. So yeah, the higher price of CO2 is definitely giving a positive momentum to hydrogen, but it's all about the declines in cost of renewable energy.
Elton, one more thing to get your input on. You've got an interesting note on Enel, which has exposure to the renewable space and this clean energy transition that we're thinking about. And you've got a relatively positive view on the company's fundamentals. Tell us what you're thinking and what's in store for them over the next couple of years.
I do think Enel is going to prove consensus wrong. The consensus is well below the company's guidance, and that's partly to do with the fact that Enel has suffered from COVID, but less so in terms of lower prices or lower demand for energy, and more so from the devaluation of foreign currencies, particularly Brazilian real and some of the Chilean pesos and some of the other LatAm currencies, and more recently the weakening of dollar against the euro. So that is definitely a headwind for the company, but I think the company should more than offset these headwinds with increased deployment of renewables. So that's one. And number two, it's going to do very well on OPEX cuts through digitization and the fact that it's replacing not so profitable thermal generation with much more profitable renewables. So because of the OPEX cuts and improved margins, I do think the company is going to beat the guidance for the next 3 years or so.
Very interesting. I think this is a really good point to bring on Patricio Alvarez. Patricio looks after Inel Americas, or the subsidiary. So, and I know you've got a view out on them as well, Patricio. Tell us what we're hearing primarily from the company's operations over in the Americas side.
Sure. So just to follow on Elchin's point, I think the virus drag is still very evident in the company's results. The company reported EBITDA down about 12% year over year on Monday, and this is mainly due to the FX, the foreign currency headwinds, especially the Brazilian real and the Colombian peso and Argentinian peso as well, which devalued about 43% in a single quarter. Which are considerable headwinds. This is also amplified by the sort of easing lockdown restrictions in these countries, which are sort of intermittent. They go into lockdown and out of lockdown, so this also affects power generation volumes for the company. But what we see underneath all these externalities is a strong growth outlook for Enel Americas, especially following their consolidation with EGP, which contains a lot of renewable assets, which has increased the renewable capacity by about 30%. And they have also granted access to a very large pipeline of developments in Brazil, especially, with the target to increase the renewable capacity to over 22 gigawatts in the next 2 to 3 years, whilst also increasing their footprint in Central America.
Patricio, very interesting. You also cover some of the Latin American E&Ps for us. How does that story contrast with what you're seeing on the utility and renewable side, and how does it contrast with what Will Hare's told us about the European oil majors? What's in store for Latin American E&Ps?
So that's a good question. I think I'll take the part on the oil major comparison first. I think the oil majors transition into a greener, more sustainable sources of power leaves a lot of legacy assets behind, especially in regions like Latin America. And what we're seeing in the results, obviously, improved oil pricing is resulting into increased liquidity for a lot of the junior E&Ps. And we've seen a divergence of a couple of them that will have the headroom capacity to the balance sheet capacity to pursue further growth. And this, we think, will result in M&A activity. Probably Brazil offshore will look attractive, especially if there's any legacy assets that they can try and capture there. And also offshore Guyana will be very interesting. And like I said, I think I'm about to publish a note on their previews, just trying to highlight which companies are a bit better geared to have that growth capacity in their balance sheet. In terms of how they compare to the utilities, especially Enel Americas is a good signpost for the renewable activity. For utilities activity in Latin America, as it is the largest there. What we see is that obviously volatility for the LATAM E&Ps is massive, given that their FX headwinds are more cash at the cash flow level, since they sell oil in dollars and all of their costs are locally denominated. So you can see these really high volatility in their cash flow generation. So we expect 1Q results to be probably ahead of consensus in many cases, just because of this dichotomy in costs and in revenue.
Thank you, Patricio. I want to swing back around to Will Hares and ask about the broader commodity and price environment. So clearly, we can talk all day long about sort of where companies are at on the cost perspective, what they're up to individually, but we didn't start off the conversation like we frequently do with a discussion of the commodity price. So looks like oil's flirting with $70 a barrel. Will, what do you make of the broader macro environment? And in particular, I'm curious to hear if you think a potential restart of Iranian exports could have a much bearing on the market. How do you read that piece of the story?
Yeah, so we still see significant OPEC spare capacity on the sidelines here. We've just seen a very limited reduction in OPEC production constraints over the next couple of months, and the Saudis easing their unilateral 1 million barrel a day cut over the next few months as well. So there is still a lot of capacity on the sidelines here, and this $70 could be a bit premature, particularly given what we're seeing out of India with very troubling COVID case rates and death rates, with increasing concern over the new variant that's ravaging the country and the potential spread of that. So we remain cautious on the oil price at the moment. There's a few potential downside factors. increasing OPEC production near term. There's also the demand factor with the Indian variants, and of course Iran is no longer really a wild card anymore. Iranian production has already started to come back, and so we are expecting a roughly a million barrels a day to come back further by year end from Iran, given we're seeing some very encouraging signals from the U.S. and from Iran on resumption of the JCPOA.
And I want to come back to Elchin in a second to sort of get his view on the gas market. But before we do that, I think there's one piece of the Iran unfolding narrative that might be interesting to get your thoughts on. Will Total had previously been exploring a gas project in South Pars. If this agreement unfolds and we get back into much less tension between the U.S., Iran, and others, is this something Total goes back into, or do they stay away?
So Total made a sort of a bit of a cagey statement on this in their 1Q, and my interpretation is that Total would be very unlikely to go back into developing South Pars, which is one of the biggest gas fields in the world, and the reading through the lines of what the Total CFO said was that a project of this size and scale and an asset life, you're looking at multiple political cycles down the line, and it appears to me that Total does not deem the this political environment to be stable enough to commit to re-entering the project over the long term. So despite stabilization near term and the JCPOA might be being brought back, that doesn't appear to be sufficient to justify re-entry of Total, given potential further changes or reversals 4 years down the line.
Very interesting, Will. So to perhaps summarize a little bit, I think that there are a number of factors that could be weighing on the oil price sentiment. And Elchin, when you read across into European gas market, give us a sense of where you think things stand. Are we in a super cycle? Could things calm down? What's your read of the tea leaves?
We were bullish on gas a few months ago for several reasons, and we still remain bullish, although not as much. But the recent bullish factor is the fact that Gazprom, for different reasons, decided not to book the capacity at the Ukrainian pipelines, additional capacity, and that meant that Europe is relying more on LNG now than it should have been. So Gazprom is basically giving up some of the market share to LNG. So Europe is now competing with Asia for LNG, and that's bullish for gas prices. So that's one of the key issues. Why Gazprom did that? Perhaps to put a pressure on getting Nord Stream 2 pipeline over the line. So that could be one thing. And it wouldn't hurt to have higher gas prices in Europe. But yeah, the gas storage volumes remain very low at the moment in Europe, well below 5-year norm. So these are two the key bullish factors on both supply and demand side.
There's a pretty interesting contrast of narratives. We're on the cusp of potentially seeing a breakthrough between U.S. and Iran, more oil flowing there. What's your read on kind of where Nord Stream 2 stands? When does it get finished? When's it come online?
I think it's realistically we're looking at finishing and coming online. I think that there will be two separate things. It's going to be finished this summer, I think, by the end of the summer. However, it won't start pumping gas until it gets all the permits. And to do that, you need some sign off from different auditors and whatnot. And very few people want to get involved in that project for fear of US sanctions. Biden is meeting Putin soon in Europe, hopefully, but the situation between the two countries is terrible at the moment. So I think realistically, probably we are expecting Nord Stream to start pumping gas at some point, but it's likely to be 2022 rather than this year.
Very fascinating. I think this is going to be a great place for us to stop. If you don't use BI on your terminal, please check it out, BI Go. We've got dashboards for each of the sectors that we cover. So if you want to learn more about the oil majors, you would go to BI Intog for the Integrated Oil Group, or BI EGen to look at the utilities. So reach out to us, ask us questions. We're happy to talk about the research and the platform. So I hope everyone has a great remainder of the week, and thank you very much for your time.